Hello and welcome to Mlika conference. Mlika, as the name suggests, is Mlika, which is a Swahili word meaning shine light on something. My name is Dr. Tony Mwanza and I'll be your host. I am currently the CEO of Kenya National Innovation Agency, which is a new agency that was established to promote and nurture the innovation system in Kenya. I've been there a few days now, barely 3 weeks, as I try to lay the foundation of what we're going to be doing over the next 5 years. So what is Mlika attempting to do? Mlika is a program that was started some months back to identify a set of promising startups in Kenya and then find a way to shine some light on them as a way of enhancing their discoverability. And we're here to crown that phase one of that project, where we'll be celebrating and shining light on the 100 startups that had been identified. So a lot more startups were identified, nominated by stakeholders, and then a team of independent jury was actually involved in shortlisting and kind of grouping them, and that is pretty much what we're going to be celebrating now. Now, the parameters used, of course, to identify include, value proposition design, the pathway to scaling, the potential impact of these startups, the penetration or the impact they have already had, their team composition, and so on and so forth. Now, of course, understandably, there can be elements of subjectivity here and there, depending on how the exercise is done at the judging level, or if the information was available for all the startups in Kenya to actually be identified. So there may be, of course, gaps here and there, but this is a starting point, and our hope is that we'll continue to build this movement into the years to come. So we're now letting you know, okay, so who are the partners behind the Mlika program? The initiative is supported by University of Nairobi, ASEC, Kenya National Innovation Agency. There is Make IT, who are providing some technical support towards this program, and our hope is that into the years to come we will continue to grow the number of partners behind this initiative and make it as a flagship initiative for the country as an avenue of increasing visibility and discoverability of our startups. So now our event is online. Initially it was meant to be physical, but now we have to run it as an electronic event because of COVID-19. Now we've got this platform Hopin that we're using, and I'd like to hint to you that you have a chat section on your right, and you're very welcome to raise questions over there and make comments, but preferably as you do that, introduce yourself. Let's get to know your name, and let's get to know maybe the startup or the organization you're coming from, so that as we respond to the questions or make comments in reaction to your questions or comments, we actually recognize you as well. We will be inviting questions through the chat. So there is no opportunity really for vocalizing questions. So you are invited to post questions anytime in the course of the event that we're going to be running. And then you're also invited to participate in the polls. So we'll have a few polls which will give us a sense of how the participants are responding and participating in the event, and then in the course of time we will have an opportunity to make improvements. So let me tell you a little bit about this conference. Now we've got a 5-section conference running between now and Friday afternoon. Today we do the first section, which is more like a pre-event, that is a masterclass for investor readiness. So we invited startups and other stakeholders who may want to participate, and we'll have a subject matter expert who will take us through the elements on investor readiness, thinking through the stages, thinking through the preparation that is necessary, managing the relationships, and so on and so forth. Then tomorrow morning, we're going to converge here and listen to a selected set of startups who will share their stories about how did they raise funds. In the recent past, they've managed to mobilize some resources to support their startups in different ways. And they've had different kinds of experiences, and they'll be sharing their stories. So we've picked about 4 startups. And we'll want to ask them questions, look at the challenges they faced and the success factors, according to their individual stories. Tomorrow afternoon, we'll spend more time listening to a number of organizations that have products that startups and SMEs can participate in. And the idea is that each of them will tell you a little bit of their expectations, their experiences, their application process, and so on and so forth. Then we'll move on to Friday morning, and we're going to spend some time with some ecosystem participants or stakeholders who've got specific initiatives. Think about Konza Technopolis. What is it that they've got in supporting the innovation ecosystem in Kenya? We're going to spend some time with the Ministry of Industry, Trade and Cooperatives. We're going to spend some time with ASEC, and so on and so forth. Then on Friday afternoon, we're going to be unveiling. And so our focus on that day is going to be who are these startups? We'll listen to some of the partners behind this program. And then who are the startups that have been selected? And how are we going to unveil? So we're going to be doing that digitally over here, and then we can have a reaction and engagement about that particular experience. So I look forward to your participation. I'll be your moderator all through these sessions from the beginning to the end, as part of the leadership team that was involved in shaping the Mlika program, which is now a pilot phase as it moves towards stability over the years. Now we'll be very active on social media, and our hashtag is going to be Mlika Startups. That's going to be a generic hashtag over the years as we grow the program. And for this particular year, we've got Kenya's Emerging Startups 2020. Now, as you post on Twitter, Facebook, and so on and so forth, please tag the following organizations who have been part of this program: at Make IT Africa, at ASEC News, at Kenya Updates, and at Bafunde, who are the studios that we are using today for this event, and recognize the contribution of these initiatives. You can tag in at University of Nairobi, at UNBI, who have provided the technical foundation for the program as well. Also, that's a little bit about the housekeeping. So we will now go into today's session. And in today's session, we've got a subject matter expert, Mr. Jason Musyoka. Now, Jason has been working with Victoria Ventures and is still with Victoria Ventures, who are active in the investor relationship with, between startups and investors, and has had a lot of experience in doing this and delivering the results associated with it. So you are going to be invited to participate. He's going to break the session into a couple of components, and after each of these components, we'll have an opportunity to ask questions and give feedback. Now, it's my hope that we'll regroup again after he has completed in about 2 hours or so, and I hope you make the best out of this moment as we transition to the next. Stay in touch and see you later.
Good afternoon, and thank you, Daktari, for the good introduction. My name is Jason, as Daktari had mentioned to you earlier, and I'm going to be facilitating the Investor Readiness Program. Ordinarily, if this was a physical conference, I'll have asked people to introduce, to say what they do, what exactly it is that they have been doing, and how they have been doing what they're doing. So that will have taken a physical introduction, but since this is a virtual conference, I think we're going to skip that part, and I can say I'm comfortable with just introducing myself and knowing that the participants are also people that are looking forward to this masterclass as well. Now, maybe just to set the context, it's always good to set the context of the program. So maybe I can just begin by asking the participants, first of all, is how many of you have ever engaged an investor? I mean, feel free. I'm sure there is a chat bot. There's a place where you can respond by saying how many of you have ever engaged an investor or have some level of conversations with an investor. And maybe just to keep the questions moving, the second question will be how many have raised funds before? Even though you've engaged an investor, probably you've raised funds or you're not raised funds, but it will be interesting just to see who has raised funds initially before. So you can use the chat bot there so that you can at least give us the responses, and then we can pick it up from there. It will be good just to gauge the level of the participants, just for me to get a better understanding of where you are as startups as well. And maybe the last question is, give me 3 objectives of learning objectives from this session. If I can also get an understanding of that, it will also help a lot. And hopefully those objectives, some of them will be articulated in the presentation, and the ones that are not articulated, I'll receive the questions from the team here, and then I can be able to respond on them on a one-on-one basis. Great. As we wait for everyone just to get to feed in their answers as well, maybe one of the things that I was thinking when preparing for this session is that the fact that it's a virtual conference, that you cannot directly interact with the audience. I mean, even making jokes is going to be hard because you cannot see who's laughing and who's not laughing. So I'm going to try as much as possible to make it a joke-free session as much as possible, but at the same time making it a very interactive learning session. So just to look at some of the responses that are coming in. Great. And there's no learning objectives can be anything. I mean, you don't have to. There's no right or wrong answer as far as the learning objectives are concerned. But it will be. I'll be keen to see what people are thinking from a learning objective perspective. Great. So fantastic. Those that have managed to give us a bit of feedback on as regards the 3 questions are concerned. Thank you for that. And maybe just since we have a time limitation of 2 hours, to make sure that we make the sessions to deliver the session, I'll try to be as articulate and try to see how I can move in cognizant of the fact that that we have a time limit. So after every section, just to give you an overview of how the sections are structured, after every section, you'll be able to pose your questions regarding that session, and then I'll be able to respond eventually once we close the session. There'll be a Q&A session eventually after the whole presentation, but after every session, I encourage you to pose questions relating to that section, and then I can take those questions later, and then I can see how best to respond to them. So wonderful. So also just let me give, in brief, just let me outline what are the contents that I've prepared for you today. So I'm going to talk a bit about Victoria Ventures. I think Dr. Omanza had already alluded to the fact that I come from the investment side, and I work with a company that is called Victoria Ventures. I'll introduce it a bit and just tell you what Victoria does and what we seek to, that we try to drive as far as the early stage or investment ecosystem is concerned. And I'll also talk a bit about the funding landscape, which I think is a good thing for you to have cognizant of, because eventually, whether you're raising funds now or you'll eventually raise funds, you need to see where you can go to access the capital that is required. And then I'll also talk a bit about the investor readiness process and what, as an entrepreneur, how do you prepare yourself? How do you plan around making sure that you're investor ready, so that when you engage with an investor, it's quite easy for you to have an end-to-end conversation without necessarily having without necessarily having a lot of gaps in between. And then lastly, well, not lastly rather, but I'll tell you a bit about term sheets, because the whole idea of engaging an investor is eventually to get a deal structured or to get a deal out of it. And that necessarily means that you'll have some conversations around how do you structure that deal with respect to that investor that you have that conversation with, and term sheets come in hand to learn what to expect when as far as term sheets are concerned, and how they can facilitate the deal structuring process. And then lastly, I'll talk a bit about negotiations, because investor engagement will largely also depend on how you negotiate your position, and how also the investor negotiates their position, so that you get something that both serves your interest and also serves their interest as well. So let me get right into it. Just tell you a bit about Victoria Ventures. So Victoria Ventures it was registered as we started off as an enterprise support organization, so we are looking at companies in the early stage sector and saying, how do we drive value given our background in the finance sector? And then over time, we gave a bit of training to these enterprise support organizations. Those kind of organizations are accelerators, and they're also incubators, people that are trying to drive value to the startup ecosystem as well. So we leverage on our experience to see how we can also drive value to that ecosystem. And then we realized that that in itself was not necessarily moving the needle. So from 2012 to around 2015, we started now engaging, trying to leverage on our network as well to make sure that we manage to deploy some capital from ourselves and also from our network of friends and family to see how we can deploy some capital into some of these startups that we've been working with. And that is how the whole idea of Victoria Business Angel Network came about. And that in itself gave rise to the angel network that we're currently running. And right now what we're doing essentially is to try to see how we can facilitate an investor conversation with startups that are coming or as a part of our deal pipeline as well. So that is really much about Victoria Ventures, but I'm sure you came here to learn more about the funding landscape and not about what we do. But I will be keen to have a conversation, an investment conversation with some of these startups that eventually manage to apply to us as well. And hopefully some of them will come from this Mlika program. So let me introduce the funding landscape briefly, just to tell you about an overall view of what it looks like. And then on that basis, you'll be able to see where you can go to have these kind of conversations with people that can facilitate capital to your startup as well. So that is what I want us to look at briefly. So what to expect from the funding landscape? We'll look at what's getting funded, and also we'll have a brief look at who's undertaking the funding. Of course, Victoria Ventures will be part of that, who's undertaking the funding. And then lastly, we look at what are the challenges that these investors are facing when they start interacting with entrepreneurs as well. So that is what largely we'll be looking at in the funding landscape. So let me start off by looking at what's getting funded. And here I would like to, I'm sure you can see on the screen there, you can see a map that is indicating the companies that have gotten funded at least as far as 2019 as a financial, in the investment year of 2019 is concerned. You can see the startups that are getting funded and the ones that have already gotten funded. So that is what it looked like, at least from deals that were revealed to people that are collecting the data. That is how the funding landscape, or the funding Africa startup that are raising anything between $50,000 to $999,000, or at least less than $1 less than $1 million. So overall, those kind of companies, they managed to secure around $21.7 million. And you can see, of course, Kenya is represented there as the third highest recipient of these funds. But what I would like you to pay more attention to is the kind of sectors, the top sectors that was really getting funding. Where did a lot of that money go to? And of course, the lion's share went to fintechs and e-commerce opportunities. And of course, you can see a bit of representation from health and biotech as well. So those are the main sectors that got funding. That does not mean that other sectors did not get funding. It's just that the investor appetite was more skewed towards those kind of sectors or startups that were trying to facilitate and create efficiencies in those kind of sectors. And the next slide, I would like to look at deals that were above the $1 million cap, or the $1 million level. So those similarly as well, Kenya also was quite well represented there. But of course, you have the lion's share going to the south and West Africa as well. So, but also from a sector perspective, you can see similar to what we had seen between the $50 to $1 million range. We also see the fintech is quite well represented there. And then you have other sectors that are of interest, like renewable energy as well. And now let's narrow it down a bit to the Eastern Africa side and see how that looked like. We don't yet have the latest data for 28, we just have data for 2018. At least that is what we managed to get to source. And as you can see there, the different sectors that got funding, and also and how the funding landscape was like in the Eastern Africa region. So maybe just as a close up to this funding landscape, as a close up to this funding, to what was getting funding, I would like to share with you this slide, which shows the top companies in Africa that raised money in 2019. And what I would like to highlight in this particular case is that probably not all of them had an East Africa origin. But of course, with time, we expect to see a bit of that move away from the rest of, from just being concentrated in West and Southern Africa. And also we can have a bit of representation in the eastern side of the continent. So who's undertaking the funding? That's $21.7 million, and the people that are also funding $1 million. Who are they? Where did they come from? What kind of investors are they? So from an investor point of view, you can see most of them, we have a lot of VCs, we have a lot of family offices, and also we have a lot of private and other funds that are trying to deploy capital in the region or in the African entrepreneurship ecosystem. So at least what is quite positive from this image is the fact that there are people that are giving funding. So you don't have to be worried at this in Africa. There is a significant investor presence in Africa. So that should not really worry you. And I'm sure as you begin your own investor journey, fundraising journey, some of these people will become familiar names to you. And what now I'd like to say, at least to highlight or to present, is the different elements in which they handle or how they differ from each other. So you can look at them from a stage of investment perspective, you can look at them from a structure perspective, and you can look at them from a governance or the risk reduction strategy perspective, and also where they got their funds from. So it's good to understand the different types of investors. It's good to understand the different type of investors so that at least you can be able to know what feature or how aligned they will be with regards to why you're asking them for funding. So of course, the easiest or the most accessible kind of funders are the impact or grant funders, because largely they do not focus on the bottom line aspect, or they do not really focus a lot on not on corporate governance, but trying to take a lot of to get involved significantly into a company once they give funding. They are more interested in the kind of impact and in the societal and the social and other elements of impact that their capital produces. So you can say they are the low-hanging fruits that most entrepreneurs can have access to, and try to see how they can leverage on connections that they have to get this kind of funds from the impact and grant funders. Of course, angels and VC will come in with a bit of more experience and a bit of more exposure to the entrepreneur, but they'll have some level of requirements that they'll be looking into before they give or they deploy capital to a startup. So largely, the main differentiator between a company is really to do with the source of funding. For angel investors, they typically invest their own funds. They have probably accumulated some amount of capital, and then they want to see how they can use that capital to deploy from a risk-reward perspective, or how they can play their hand in the private equity sector and see what they can come out of it. And this is largely driven by a desire for returns, as well as a desire to give back to society or to create also some level of impact as well. But I would say that is the main differentiator, because VCs typically are investing funds not of their own. They have sourced funds elsewhere, and they're coming to deploy those funds to the stage I've identified from a returns perspective. The reason I wanted to share this slide is so that at least you can measure yourself where you are and which kind of investor is good for you given the stage of your company. So of course, if you are a very early stage kind of startup, the immediate access to funds that you have is from friends and family. And after that, of course, you have your angels and some grant funders that come in after that as well. Once you have a bit of a prototype and you're trying to see how do you take your product to market or how do you take your solution to the market. So you have a bit of angels and grant funding also coming in there. And also you have seed stage as you keep on, of course, escalating in your growth. You now start engaging more institutional investors, and these are the kind of the private equity and the venture capital people come in at that stage so that now they can boost your operations at a larger scale than what the angels and probably grant funding could have done. And of course, you go on as you keep on progressing. Eventually, if that is the path that will ultimately lead you, your startup will lead you, you will end up as an IPOing or offering your shares now to the public so that you can see who else, that you can access a larger or a wider pool of funds as well. Now, we are an angel network as Victoria Ventures, and it will be good. It will be good for me just to share which other networks are out there, because you might find yourself engaging more angel investors than initially in your funding journey, as opposed to engaging institutional investors as well. So I like to share this slide so that at least you can be conversant with the angel ecosystem and see where, if you need angel investors, depending on which part of Africa, of course, you're from, these are the people that you can start now engaging earlier on before you even start moving to your institutional investors. So what challenges are ourselves as an angel network and also other when they start engaging entrepreneurs? So, of course, most of those will be internal, and others will be external as well. Largely speaking, I think from my VC interactions, so people, our VC partners, and because there's a lot of collaborations when it comes to investor trying to identify opportunities that they can invest in, they tend to work with each other so that they can say which companies have been looked at, which companies have you looked at that seem interesting enough for us to make a co-investment in. So, and because of that, we tend normally to exchange experiences. We tend normally to look at things from a similar lens or a similar perspective. And this, but just to highlight a bit of the challenges that we face, like I said, some of them could be internal and also others could be external as well. But I'd like to point out two that probably stand out, and I think as entrepreneurs you need to be quite aware of, and because it could be the make or break between your conversation with your investor and yourself as a company that is looking for funding. And that has to do with a lot with the valuation element. There is this creeping ideology that startups across the globe should have a similar valuation depending on which stage of growth they are, or which stage of their company they are. So, but what will be good for entrepreneurs to keep in mind is that they should be very context specific, not necessarily mean to mirror other ecosystems. They can just be very specific to your own context. And I think a lot of disagreements at the valuation element, because now you're talking about how large of a cake should we be able to split between yourself as an investor and yourself as an entrepreneur. As an entrepreneur, you think your cake is too big, but as an investor, they can say maybe your cake is not too big as you think. So that is why maybe the element of valuation is quite key, and it needs to be an evolving conversation. But at least once, if you're cognizant of the fact that you can disagree on valuation, then you can start seeing how you can create other avenues of agreement so that does not become necessarily a big deal. So, of course, regulation is another thing that you need to be aware of. Our regulation here is a bit good for early stage companies, but And of course, there are measures by the government to see how they can be able to fast track that element of regulation to make it as streamlined as much as possible for companies that are looking to start on or are very early in the entrepreneurial journey. So, having said that, maybe I can take 1 or 2 seconds just to see if there's any questions with regards to that, but I'll note them down and then I'll be able to respond to them eventually once the session closes. But now maybe I would like to engage the participants and ask, get some level of understanding of if there's anything that out of the funding landscape that they want to know more. What are the key areas that we're going to focus on today? Of course, the first one, and the most important one, is how do you analyze your business? Have you analyzed your business? Have you thought about your business? Have you taken stock of where you are from a business model perspective? Have you looked at whether you have product market fit? Have you looked at whether you have a significant amount of customers that you're trying to deploy a solution or your product to? So analyzing the business is one of the things that we'll be looking at from an investor readiness perspective. And then we'll be looking at the funding requirements. How do you establish the funding requirements? How much do you raise? Where do you, how do you need to raise money? Or how much will I be able to raise? Will you be able to raise as an entrepreneur? Or what are the characteristics or qualities that need to be internal or external for me to be able to say I'll be able to I'm adequately positioned to raise capital? And another thing that we'll be looking at is the process of due diligence from an investor readiness perspective, because in very few instances will you find yourself not undertaking or not being necessitated to go through a due diligence process before you receive capital. At Victoria Ventures, I can tell you for a fact, we rarely invest in deals that we have not done some level of due diligence upon, and then on that basis, we make an investment decision. But due diligence is a critical element of the investor readiness process, the engagement process. Then we look at the whole process itself. What is the investor engagement process like? What needs to happen? What is the process of fundraising like? What are the different types of investors that I need to be thinking about? And which investor is right for me? How do I identify the investor that is right for me? And how do I make sure that I can position myself to have a conversation, an investment conversation with them? So that is what we should be looking at. And also elements of, do you need an advisor, or do you need to interact with someone who has engaged investors before so that they can facilitate the conversation for you, on so on and so forth. And then lastly, we'll also take a look a bit at other considerations or with regarding to the investor readiness process. I mean, do you need a board of directors? Do you need, when should you raise another additional funding as an entrepreneur? So you're going to look at all these elements, and I'm going to break them down sequentially, and then we'll look at them step by step, and then we'll be able to interrogate every area that I've highlighted here on its own. So, of course, to start us off is also a need to understand why we need to plan for the process itself. Why do you need to plan for the process? I mean, I imagine every significant thing that you need to do in life needs to have prior planning for it. But more so does the investor engagement process need a lot of planning. So why do you really need to plan for it? The very simple reason that I can of course share with you is the fact that it's a cycle. You'll be doing this over time. You're not going to raise your capital requirements for the entire period of your company at once. You will be doing it again and again. You raise the first initial round, and then of course you will scale your business or you scale your operations, and then you will be needed to raise an additional rounds of funding as well. And then on that basis, the fundraising and the investor engagement process is going to be cyclical, at least until a point whereby you feel that you sufficiently have enough cash flow for you to take the business where you want to take it. But fundraising and investor engagement is going to be a cycle that you're going to have throughout your funding journey and also throughout your entrepreneurial journey. So so why it is important, of course, first of all, to estimate the right amount and the right structure of capital that you need. Do you need debt or do you need equity funding? And also then secondly, it enables you to have a better alignment with your investor. There is no, it's going to be, once you get investors into your company, they're going to be engaging you every so often. And you want to be in a position whereby you have very good relations with them. And that the relation is only comes about if you are well aligned from an interest perspective. And then of course it cuts down its time. It takes a lot of time. I mean, it's quite involving. You'll need to respond to some questions, then you need to go back again to drafts, produce some data for the investors, and then this back and forth will take a long time, and it can actually distract you from your core objective, which is building a business. And that is why you need to plan for it so that you can spend the most your time very efficiently while engaging your investors as well. And then lastly, it allows to target, and it allows you to target the right type of investors. I mean, so that because of like in the previous slides that I shared, whereby you saw there are a lot of many people that are providing funding in the early stage space in Africa. So who do you know who's the right person that you need to go and engage? And planning for it you can put aside the ones that you don't need to go to because they don't fit the criteria or the funding requirements that you have, and you can put aside others because maybe the objective for funding is different from your objective as a business. And on that basis, you can identify the kind of investors that you're going to be interacting over time. So let's look at the first one, analyzing the business. I'm sure most of you have come across the business model canvas, or at least have been requested to fill one, or you know someone that has already filled one, or you have attended a program that has required you to fill one. So the business model canvas is one of the tools that we highly propose to entrepreneurs just to have a look at. Even necessarily need to focus on it immediately, but they should be able to at least have an idea of what it is and how effective it can be as a tool to understanding your own and analyzing your own business, because it really helps in articulating the business model for you. More often than not, you are asked by someone, what do you really do? And of course, you know what you're doing. It's just that you cannot articulate it properly. But for an investor, they want you to see how well you can articulate what it is that you do. And I think the business as a tool in itself can really help a lot in helping you articulate your own business model and what it is you do as a company. And also to be able to, you can say some level of, you can also be able to exercise where you think you're not directly creating value, or if you thought your business model is different from what you have been able to extract from the canvas, then you can also try to see how can you put it together so that it can be well articulated and it fit what you have in mind as an entrepreneur. So it can also give you some level of control over your business model as well. And then of course, you'll also be able to understand how you engage your customers, or how you can better engage them, because once you fill it out and you see what is the current channels in which I'm engaging my customers as an entrepreneur and as the customers who are buying my solution or buying my product, and then once you identify how it is that you're doing that, then you can also be able to improve on those processes. Of course, you can be able to improve on those processes, and it's through trial and error, see which process works best for you as an enterprise and see which one does not work best for you as an enterprise. So also it helps you to better engage your customers as well. And also it helps you identify your unique selling proposition. What sets you apart from your competitor? Why is it that people are coming to buy your product or solution and they're not going to your competitor? So the canvas also, it helps articulate these different elements of your business, and also which is a more critical one, which is the competitor element as well. And lastly, it's what are the defensibilities around your business model? How do you make sure that you are structured for long term? How do you make sure that you're not going to suffer when something comes about? So like, for instance, I mean, the COVID situation came here. I mean, all of us are quite aware of it. It might have affected your business. It might not have affected your business. So knowing how defensible your business model is helps you better prepare for situations like this, both seen and an unseen situation. So like now for the COVID situation has really helped us learn to see ourselves as enterprises differently. Know that they're better, that we should always have alternative ways of engaging our customers, not just the physical element of engaging with them. So how do we define those different customer channels? How do we define ourselves? How do we make sure that the business model is not affected by changes in changes in practices, like the way now offices have closed, and if you're a significant supplier to office space or offices, how does that impact you? Or how do you structure your product to make sure that it has longevity from a customer needs perspective? So the business model is one of the tools that we say, as an entrepreneur, try to take advantage of it and see what it tells you about your own business. So maybe to focus on some small thing from the business model, from the canvas, is the product market fit, which I think is very important for people to articulate and have a good understanding. The reason I want to highlight this specific one is because it informs it informs a large part of the decision-making process of any investor, because no one wants to invest in a company whose product does not fit the customer needs that they're trying to service. It's very redundant, and it's one of those things that investors really keenly look at, of how well you've articulated and understood your product, and how well you've articulated and understood the customer needs, and what product do you have, what service offering do you have that perfectly meets those two expectations. So that's why I want to focus a bit on the product market fit. So the first question, of course, that you want to ask yourself is, do you have proven customer demand? How big is it only your friends and family that are using your product? Keep in mind, you have to see beyond your initial customer segment to see if there are any other people outside your circle of influence that can also find value in the product that you're trying to supply to them. So that is why it's important also just to understand if you have proven customer demand, or if you have a product that has a wider customer demand as well. And then do you have a minimum viable product that at least has gone out to the market and be tested, so that you can understand that is the right solution that they want, or that is the right product that they're actually looking for. Because more often than not, you find that companies keep on recalling products because maybe it was not the right product market fit for them, or it was not addressing the needs of the customer that they had initially. So they keep on recalling the products that are off the customer expectations. I'll give you an example of one, and maybe it's good to give this example because the company in itself, it's one of those companies people think they can do no wrong, or something close to that. So I'm sure most of you are acquainted with the Safaricom Homebox, or there's a product that Safaricom was trying to roll out that was going to be a direct competitor to DSTV and the likes. But I don't think they're taking the time to understand why it is that DSTV is what it is, or I don't think they're taking the time to understand why other on-demand providers are successful. So that kind of mismatch between what your customer are expecting and what you're providing to them as a service provider is what you want to minimize the gap in that expectation, so that at least when you roll out your product and when you roll out your service, it perfectly meets, of course, over time, it perfectly meets what the customer are expecting from a demand perspective. And then, who are your early adopters? Which immediate customer do you have access to that you can go and test out your product in? I mean, and how fast can you access them? So that is something else also you can, as you're trying to figure out your product market fit, is something else that you can take a look at and see, okay, fine, the first people that actually address this market, so that at least you can understand if it's meeting the expectations, then you should be able to take it to them. And then, of course, over time, you'll be, as you engage investors, they'll be asking you questions to do with, we know you have early adopters, but what is the total market size? How big is the market that you're really trying to address? How big is the problem? How big is the need for that solution? so that if you have articulated this, and then you can say this is, you want it because what investors are looking for that big problem that has a very good solution that is coming to meet that customer expectation. And then once you articulate your total market, then it will be, it incentivizes investors to say, to look at your company more keenly, because they can see that the market that the product is trying to address is very large enough to warrant the solution that you're providing. And lastly, well, not really lastly, something else also you want to figure out when you're doing your product market fit are the unit economics. What is the cost for me to provide to one customer what I'm providing? What is the cost to me as a business to provide the service or to provide the solution that the customers are demanding? And then once you learn that, because then it helps you to price it properly. The thing about unit economics is that you learn to price your products very well, because you can see the costs element that are necessary for you to supply or provide that solution. And then once you understand those costs, then you can also see what is the pricing for me to make sure that I have a viable business as well, because you don't want to be running in losses because you can't cover your costs. So understanding your unit economics also helps you see how you can better price your product or your service as well. And then lastly is just in a demonstrable product that can be utilized by the investors for them just to have a look at. And I think it ties back to what we had already said, having a minimum viable product that investors can at least relate to and see what is the customer journey. If they were the actual customers, what is the customer journey, or what is the customer process? And then on that basis, they can be able to see, is it arduous or is it something that customers can actually find fulfilling? And then we look at now establishing the funding gap. How do I know how much I should raise? So the growth and the projections. So of course, once you understand what are your growth numbers, or what are your projections, or where do you want to be in the next 5 years as a company, from a customer acquisition point of view, also from a revenue perspective, then you'll be able to know or establish what we call the funding gap as investors. So once you establish that funding gap, and of course from that diagram, we can be able to see how as a business you can at least see where it is that you will need, or at what stage you will need, so that you can start raising capital or start engaging. Because if you continue in that growth trajectory, of course, at some point, if you don't get external funding as a business, you will collapse. And that is what I think we as investors refer to, and also other early stage ecosystem partners refer to as the valley of death. So once you see when you're likely to fall within that valley of death, when you are going to necessarily need external capital, it's important for you to establish the time you have before you get to that point, so that you can start planning for a fundraise or start planning for an engagement exercise. Of course, those projections will help you to identify if you need to raise money. And like I'd mentioned already, it depends on the stage of business you are at the moment. And then it will also depend on what other aspects, or what are the sources of funding before I even go out to attract external capital. Where else can I get money without necessarily putting myself in the cross paths of investors? And then those are the other avenues that you can identify there, like crowdfunding or commercial debt or grants, or you can even continue bootstrapping and still see how long you can push it before actually you have to go and engage an external capital provider. Then it depends as well. It depends on as well if you're running a lifestyle business or you're running a scalable company. Lifestyle businesses are companies whereby you're not building an enterprise per se. You're building a company that can support your obligations and your lifestyle. Let's say every summer you like to travel to Europe, and so that means you'll be unavailable to your business for 4 months. If that is the case, then really you're not necessarily creating a scalable company. You're largely trying to do what you're trying to do is support or get some level of support for your lifestyle by selling a product or providing a solution that somehow has some level of customer need. It's not necessarily something that you want to scale beyond your customer base already, because then if you're already comfortable with where you are as an entrepreneur, then as an investor, if there's no sufficient motivation for you to grow your business, then I'm not incentivized to give you funding as well. So understanding if you are a lifestyle or you are a scalable business is important. And then another type, and also understanding is, are you a consulting company or are you a company that is providing a specific solution? Well, not rather, but has a recurrent need but not from a consulting point of view, because consulting companies, they largely depend on networks and how well your networks are. Of course, at some point they'll outgrow that network, and then you'll have the brand and visibility that you need to sell your product without necessarily having it tied to you as an entrepreneur. So of course, understanding that and also being able to articulate and explain to investors why your consulting business merits to be considered from an investment perspective is quite crucial as well. And it depends as well. So it largely depends on those two things, or lifestyle business, or if you're a consulting business, or you're building a scalable business. Once you get a good definition of what you are as an entrepreneur, then it will be easy for you not to have a lot of tussle with investors, because you're going back and forth trying to establish what kind of a business you are. It's good if you already understand it yourself before you present it to an investor. It's okay for you to present a lifestyle business. I mean, there's nothing wrong with being an entrepreneur to support a lifestyle. There's nothing wrong with it. It's just that as long as you're conversant of that, there's not going to be a bone of contention between you and someone else you're seeking funding from, then it smoothens the whole conversation or the whole engagement process for you as an entrepreneur. So great. Now, something else that you should also be, as you look at your growth and projections, is establish your runway. See how much time you have before you run out of cash. And I think if you look at the diagram there, you'll see that in that diagram to your left, you'll see there's all the other lines are facing up, but there's one that is facing down. And what you really want to understand is, and then there's a small portion there which is highlighted in a different color in rectangular. So understanding how much time you have before you run out of cash is quite important, because that is, of course, we'll see these can all be established. The actual numbers can be established using a financial model, which we'll look at later. But that is what we look at from a time to cash out. So that is where likely you're going to need external capital as an entrepreneur. So how much should you raise? And this is where now the financial model comes in. Enough for you to last 12 or to reach certain milestone. And like I'd explained before, the numbers, if you build a financial model, you can be able to estimate the actual amount of cash that you need before you necessarily have to start looking for external capital. So that gap in itself, what you had seen there in that rectangular box, is what is represented here as cash flow, as an investment, so that you can push your blue line to your green line, so that you can be able to support your cash flow your operations or your costs as a business, so that you can be able to survive moving forward before you generate enough revenue to support your own operations. So that funding gap, that need for external investment, is what we are looking at is what we see as the difference between the blue and the green line. So maybe the next question that we want to ask ourselves is that, will I be able to raise? How do you know? How do I know I'll be able to raise? It really does depend. It depends a lot on where you're based, of course. If, like we saw in the funding landscape, if in certain areas you're more likely, there are more there are more active investors, or there are more investors looking for opportunities in that geography. So thankfully in East Africa, we have seen that there's a lot of interest from an investor's perspective, and we see that a lot of people are looking at opportunities that can be leveraged upon to create from an investment perspective, at least in Eastern Africa. So it really does depend on where you are. It's not similarly. I mean, I'm sure also from experience you can tell you have seen how it is easier for you to undertake an operation in Nairobi as opposed to probably in a far-flung area where the capacity to spend is reduced or is not as significant as you have in Nairobi. So because of that, also business understanding for yourself as an entrepreneur is also similar to see yourself in that respect from an investment perspective, where we say, where within my region, which investors can I access? And are there actually active investors that are looking for opportunities to fund? And then once you establish that, once you see your context, once you understand your context, and of course, once you identify the different investors that are trying to make investments in your region, then that in itself improves your chances of getting an investment. And what is your business? I think you've already highlighted on that. Is your business a lifestyle, or is it a scalable opportunity? And then maybe another question to add on to that is, how well are you doing it? How well are you doing your business? Is something else that also as an entrepreneur that you need to be asking yourself. Of course, the financial model will be able to highlight this, because with the financial model, usually, as they say, numbers don't lie. You'll be able to see how you're performing from a revenue, from a financial metric point of view. And financial metrics are also something else that investors will look at. And maybe that is the best way in which they use, or that's the most, I will say that is the one that they largely prefer to estimate how well you're doing as a business. Because like I said before, numbers really don't lie. And if your numbers are painting a very good picture, then definitely your opportunity in itself will be a very good opportunity. If they're not painting a good picture, then they start asking questions. Maybe there are reasons behind as to why you're not doing you're not performing as well as you are expected to perform as an entrepreneur. So what are your connections as well? Connections help a lot. I mean, who do you know? Who don't you know? So how well do you know them? And how well can they introduce you to people that can make it easy for you to engage investors? So who do you know? Working out your connections is very important. And I'm sure you know, or you are familiar with situations whereby connections have really come through for you as a business or as an individual, and where if you wish you had connections that you didn't have, but something has happened that might have happened differently, but if you had connections, would have really improved the situation for you, or improved the outcome for you. So connections are very important as an entrepreneur as well. Last but not least, and whether you like to admit it or not, it also has a lot to do with luck. I won't say that luck is everything, but luck is also largely to not blame rather, but it's also largely plays a big part in the whole success element of yourself as an entrepreneur, whether you're getting capital or you're not getting capital. Because I'll tell you for a fact, we see companies, as at Victoria Ventures, we see companies that are pretty much doing the same thing, or largely doing the same thing. They're just in different stages of their traction. They're just in different stages of their journey. Of course, the disparity is not that big, but at least you can see there's a bit of disparity, either from a team perspective, or from a company perspective, from a track perspective, customer acquisition perspective. All these other elements are also different, but you will find that also we don't necessarily settle on one because it's uniquely different from another company, but also the fact that probably they were introduced to us by a person in the network, and then on that basis we made an investment in them because of the connection that we have. Like I said, there of course connections matter a lot, but also that was, you can call it, maybe if you look at it from a different angle, you can say they might have been lucky from that perspective. So luck also has to do a lot of it, but don't depend a lot on it. Also try to see how well prepared you can get before you meet an investor. And then on that basis, then you can now start calling on other elements that you cannot really access, like luck, to see if they can play a role in making sure that you have a successful investor engagement process. Now, the third element of what we had spoken about early from investor readiness perspective, which is due diligence, and that is what I really want to get into, and to see how do you prepare for it, first of all. Of course, I'll articulate a bit about what it entails and what it is that you look forward to and what it is and how well you can be prepared for it. But due diligence is now the planning for it. Where, remember earlier when you said, why do you plan for it? This is now the point of, at the point of due diligence is now where you start adequately planning for it. Of course, there are other aspects outside due diligence that you also need to keep in mind, but you're going to look at due diligence because at this point, as you're undertaking it, if you're well adequately prepared for it, also it means that you're going to go through the process quite smoothly. And like I'd mentioned initially, in very few occasions do you find an investor making an investment without undertaking any form of due diligence. It's like a feasibility study before you undertake a power project, because you want to see, will there be offtake? Will there be sufficient power? Will there be sufficient output from before we put in some money from this? So due diligence is necessarily a process that anything that is crucial that needs to be undertaken, they must go through. Even in social life, even in important things with regards to social life, there's some element of due diligence. We don't call it due diligence, but you can look at it as due diligence. So let's look at it again. So what is the overview? So it's largely a process of verification and confirming the risk-reward spectrum as an investor. This is on the side of the investor largely, because they are the ones who need to do the due diligence to confirm the presentations that were made by you as an investor are actually true. So it's largely a verification and confirmation of the risk-reward spectrum. If I put in some money, what is the expectation of return from you? That is what the due diligence informs. And then once you identify the risk and you are mapped, then what is the potential for, maybe other things can come in. So you identify the risk and then you map them out and then you classify. And then you say, what is the horizon before I get a return from this? Should I look at it from a long-term perspective or should I look at it from a short-term perspective? Am I likely to stay in this company for long before I realize any value, or am I going to realize value in the shortest time period as possible? So also that element, that due diligence for an investor informs them of this. But thirdly, I would say the most perhaps pertinent thing that comes from the due diligence is establishing what needs to come before the investment and what needs to come after the investment. So that is what we are calling conditions precedents and conditions subsequent. So these conditions now are the ones you need to have in place before someone says, yes, I like your opportunity, but there are certain things that I don't like. If you go fix them, then for sure, I'll give you some capital. Those are the conditions precedent. And the conditions subsequent are the ones you say, fine, once I've invested, these are the things that I want to see in your company. And we have to agree on them initially before we make any investment. The reason they might not come before is because maybe you don't have the resources to put them in place. So those are the conditions subsequent. And those two, from a due diligence point of view, because you've already established your risk-reward spectrum, you've already established that you can generate a return from this company. So what now you need to see is, how do we position that company? How do we position our return expectation? And that is where now the conditions precedence and the conditions subsequent come in. Say, have 1, 2, 3 in place before I put in some money, or have 1, 2, 3 in place after I put some money. And on that basis, you can investment, and you can have an investment engagement as well. And then it's time sensitive, so good to have a checklist or to have some form of data room prepared for the investors before they start undertaking your due diligence. First of all, it saves a lot of time on them, and it makes them make the investment decision faster. So you really want to have some level of checklist that you have undertaken or some data room that you have prepared, so that at least when they come in, it's just go. They come and do it, and then they move on. They make the investment decision, and it also frees your time, so that you don't have to talk to one investor for 7 months before necessarily making any conclusive decision from it. So it also saves your time and also saves their time. So the better prepared you are for it, the better it is for you to have as many conversations with different investors as much as possible. So there are two elements that probably for data room that you need to keep in mind. So what will the data room contain? It will contain some legal documentation, and it will also contain some financial documentation, as highlighted in those two, as highlighted in the slide there. So now you want to start talking to an investor. What do you need to have in place? Of course, before you don't, I imagine that the first conversation you'll have with an investor does not necessarily need to be face-to-face. It could be something that you have shared with them for them to have a look at, or it could be a brief that you have shared with them, or some email that you want to interest them in your opportunity. And this is where now we look at the other element of preparation for the investor engagement process, which is the pitch deck. So true enough, probably most of you here have already prepared one or are thinking of preparing one. Whichever the case, those are, I will say, these are the main things that you need to keep in mind when you're preparing your pitch deck. The introduction part, I mean, you introduce a bit of your business and you say this is what the business is all about. And then you look at the problem, so the problem statement, whereby you're now articulating what it is that you're trying to resolve from the market. And then you look at, and then something else to put there is the solution product. And then you say, yeah, this is the problem identified, and this is the solution that we have in mind to resolve this problem. And what are your advantages? Why are you the person to do it? So also you articulate it in your pitch deck. It doesn't have to be long. It can be, I think, from a page perspective, anything between 15 to 20 pages is adequate for you to be able to articulate your position. Of course, the pitch deck, because the reason I'm saying that is because there is no investment decision that will be made from the pitch deck. It is more of an aperitif, a starter, something that you, small bite, whereby you're giving it an investor to see, to sense them out from an interest point of view, whether this is something that you can look at together. And then I spoke about it, the financial model, which is going to estimate the numbers or the funding gap that you have. So it's good to have one ready, or if you don't have one ready, see how you can get someone to do one for you. And so the diagram there somehow just indicates the the need, or how as a company you can say make the projections compare with performance, or how as a company you can make sure that it's addresses from as realistic as much as possible, and it captures very well, financially speaking, what the company is actually trying to do out there from a product or service perspective. So they are necessary for business because it will be able to, as an investor, we can access the viability, and then also more importantly, we can see where are the gaps in the company? What are the gaps in the company that we need to look at so that we can plug them in and or see what we can do about them, so that at least they can be able to be comfortable about the investment. And like I think previously we had spoken about the conditions precedent, and largely some of them will be drawn from the financial model as well. And then from an investor's point of view, it can help them determine, your growth dynamics, your competition, how competitive you are as a business, or how you're looking at from a projections point of view. So once as an investor, once we see your financial model, we'll be able to sense check the financial health of your business. More importantly, more than just the financial health, is also the possibility for reward from your business as well. And then you also need to make sure that you capture, or you are as logical and reasonable as possible, and you make business sense from what your projections are looking at. Imagine you have a sales rep that has been doing month on month returns of around 100,000, and then in your next strategy session, they tell you I'll be doing 5 million month on month. And then you, of course, you're going to ask, what is the logic? I mean, what is the business sense in that? I mean, how do you move from 1,000, from 100,000 to 5 million in 2 or 3 months? So your financial model has to be as reasonable as possible. It has to be as logical as possible. It has to see, we have to see how growth is cascades across a time horizon, a 5-year period, 2-year period, 3-year period, doesn't matter. But we want to see how the growth comes about. And also, more importantly, from the financial model, it needs to be able to demonstrate how that growth comes from the company. Because what you don't want to see as an investor is numbers that don't make sense, or numbers that you cannot validate, even on ground, from either businesses doing something similar or from investors who have invested in something similar. So you really, as an entrepreneur, you really want your model to be as conclusive as much as possible to the investor, so that they can be able to estimate what potential for return do they expect from a business. And because the earlier they articulate that, the easier it is for them to make an investment decision. And then margin is everything, protect it. So what does that really mean? It means making sure that you are, and earlier we had alluded to it, understanding your unit economics, understanding where your growth is coming from. So once you understand that, then you see how your margins are being created, or where your margins are being large enough, then how do you protect them moving forward as you scale? Because most businesses tend to lose their growth margins over time. But if you can see how you can protect that growth margin, or you can see how you can protect the profit margin, even though you scale, because as you scale, you're going to incur additional costs. How do you make sure that your additional costs do not eat into your profit or gross or margins or financial margins or to your financial margins? So you really have to see what are the measures that you need to put in place to protect those margins that you have. Does that mean that you do more aggressive marketing, so that at least you can also get more customers, and then or do you need to change your business model so that you can have more recurrent revenue? How do you protect your margins? The financial model also illustrates this, and for an investor, it's very important for us to see how that is being well captured in the financial model as a business. So, and how will costs grow in relation to revenue? Like I'd said there, you don't want unrealistic growth projections whereby if we are spending less than what you are getting from a revenue point of view, probably you need to ask, is it because are you doing some magic, or what is really happening out there in the market that does not really necessarily explain how your costs are not matching your revenue growth? So what is the process like? The process is, I think I'd mentioned that it largely covers 2 elements. So we'll be looking at, now we'll be splitting them from legal and also from the financial. And then from those 2, you can say there can be offshoots of commercial due diligence and also some level of reputational due diligence. The reason I say I was not highlighting them in the previous slide is because they are not internal to you. I mean, it's imperative for the investor to see how they can undertake their own commercial diligence as far as the opportunity is concerned. It's imperative for the investor to see how they can undertake their own reputational due diligence as far as you as a founder or as an entrepreneur is concerned. This has nothing really to do with how prepared or what documentation you have. Legal and financial, that one you share with them. But these other ones, they really have to go outside their own comfort zone just to establish whether there is an objective commercial opportunity from what you're presenting, or as an entrepreneur, you have any, you can say, individual risks that they need to take care of, or they need to be conversant or cognizant of before they make an investment in you. It's what you call the certificate of good conduct, if I can put it that way. So they try to make sure that you have a good certificate before they make an investment in you, and then you don't have a bad history or a reputation of defrauding investors, or a reputation of not sticking or being aggressive, or being an uncomfortable person to deal with as far as external investors are concerned. So they do their own due diligence on you, which is important. I mean, I don't think we really foster long-term relationships without necessarily understanding who it is that you're fostering those relationships with. And more importantly, for early stage companies whose strategy is largely dependent on the founder or on the entrepreneur to make sure that they succeed. So they really want to make sure that they have backed the right horse and not backed someone who's going to take off in a different direction from what they are expecting. So that element of reputational and commercial diligence is not falls squarely on the onus is on the investor, not necessarily on the entrepreneur. That is why the two additional elements of the due diligence process highlighted in the slide were not part of the requirement from a data room perspective. So the investor engagement, how does the process look like? So that is how the process looks like from beginning to end. Like I said, it's structured in different elements. We just covered the due diligence element, and we're going to look at, of course, like I'd mentioned already before I began the presentation, that we're going to look at a bit of the negotiation element. So the two last aspects of the investor engagement process, to your surprise, these are the longest, and they're probably the most important, because problems might not arise before you make the investment. Problems normally arise after the investment, just like all quarrels in relationships. They don't come before your honeymoon stage. They come post your honeymoon stage. And whether you like it or not, problems will come. And that is why, as an entrepreneur, you need to make sure that you are having problems with the right person, not with the wrong person. And that is why also as an investor, you undertake a reputational diligence to make sure that you're going to be fighting with the right person, not with the wrong person. So largely that's how the process looks like, from deal sourcing to exit. And this is now where, as an entrepreneur, you'll be interacting with in the different stages. You'll be interacting with your investors as well. If once they become your investors, it will be at the monitoring and value addition element, and also at the exit. Before they become your investor, it will be probably the first 4 stages. We are not going to look at it independently, but I think we've covered some aspects of it from the previous slides. So, like I said, this post-investment is the longest period between yourself as an entrepreneur and the investor as an investor, of course. So that's the period that is really the longest. It's the most important aspect, because when problems come, how you resolve them is very important. Because if you resolve them negatively, it could lead to a very bad experience for you as an entrepreneur as far as that investor is concerned, which could also lead to a very bad experience as an investor. And keep in mind, also as an investor, I'm liable to other people. So we need as investors to make sure that we are backing the right person when it comes to getting a deal done with an entrepreneur. So that is why I think it's very important for you as an entrepreneur to, you can say, understand what kind of investor is right for you. Who is the person that you should be looking for external capital? I'm going to highlight a few elements, a few considerations that you should have, of course, as an entrepreneur, for you to think about as you're selecting the kind of investor that you want. Stage of business. You're not going to go to a private equity fund if you're an early stage fund. By that I mean someone who funds businesses that have presence in 5 African countries is not going to have an investment conversation with someone who has only Nairobi City as a customer base. That's not going to happen. So the stage of business you are at is very important for you to understand the kind of investor that you want. And the reason this is also very important because your stage underpins the value your investor brings to your business. Late stage, probably they don't need to bring too much value because the business in itself is quite well structured. Early stage, you need someone who comes in with additional value, and that is what I think is going. We're also going to look at that, and you need to think about what extra will they bring to my business besides just the funding, because there are different alternatives you can receive funds. I mean, we have already highlighted a bit of it. Crowdfund is one of them. You don't necessarily need to go to talk to an investor if you know how to crowdfund. Commercial or grants is another avenue. You don't need to engage an investor if you can easily access grant or commercial funding. So that stage, like I mentioned before, is really important for you to understand the kind of investor that is right for you. And what is the chemistry that you have with the investor? Of course, you need good chemistry, good rapport. Like I said, it's going to be a long-term thing. And you need to have a good rapport with your investors way before you can even engage them conclusively. And then lastly, what do you really want as an entrepreneur? Do you want control or do you want to grow wealth? Okay, let me not say wealth, but let's look at it from what do you really want to do? Do you want to control your business, to be the sole proprietor ad infinitum, or do you want to grow a company that outgrows you as an individual? Let's, instead of wealth, let's just say outgrows you as an individual. So decide for yourself what do you really want as an entrepreneur. Control, lifestyle business, or an enterprise that outgrows you, that also adds value to other people beyond yourself. You need to decide that. Once you decide that, then you'll know who to go to for funding. And then know your investors. Understand their criteria. It's very important before you approach someone. Let's assume that you have narrowed down to investor ABC and XYZ. It's now start understanding them better. Start seeing what is the investment criteria. I mean, do they invest in countries that are located in East Africa, or do they only invest in countries that are located in West Africa? Do they use debt for investment, or do they come in and ask for equity? So understand them. What is the investment criteria? Well, or how long does it take before they actually start engaging you? What do they need to see before they can start talking to you as an entrepreneur? And then, who have they invested in before? The reason I say this is because you will learn a lot about the character of an investor from a fellow entrepreneur. You'll learn a lot. And you don't take it for granted, but it's very important for you also to ask around, who have they really invested in before? And can I even talk to them to see if they will bring me issues or they will not bring me issues? I don't know how many war stories you know about the venture capital and private equity sector, but I can guarantee you there is a lot of wars, in closet fighting that is happening between investors and entrepreneurs, even as we speak right now. Thankfully, and I'm not saying that we are unique, we have not had a bad experience with any of our entrepreneurs, but I think from the war stories that you hear out there, there's a lot that needs to happen, especially for the entrepreneur. Because capital is not just capital. And the moment you secure that funding and you start engaging the investor more closely, you'll start realizing that capital is not just capital. There are other things it brings on board. And those are the other things that you need to understand way before you can even start talking to your investors for a potential investment. And that is why I say, talk to other people who have been funded by the same company. See what the experience has been. Understand and see, are you going to have the right chemistry with them? Do they bring anything else on board? So get to the ground and start looking for these kind of people who can advise you, and more importantly, make you familiar with the kind of investors that you're looking at. And of course, I've already said relationship in good or bad times. What kind of weather friends are they? Are they fair weather friends, or are they adverse weather, all weather friends? So that is something else also you can establish once you talk to people who have already engaged them before. And of course, I already talked about the more than money element, the value addition aspect that I bring on board that you need to be quite conversant with, so that at least you can say so that you can say that there's something extra just beyond the money that I'm getting from my current investors. When was it? It was, I had one of the trips that we made as an organization was to visit another ecosystem, which is not different from Nairobi. And one of the things that really caught my attention was the fact as to when most of the early stage enterprises that were located there, of course, it's a very vibrant ecosystem, but most of the early stage companies that were located there were largely looking for value add capital, not just capital in itself. And I was even surprised to learn that some of them are not looking for capital initially, but they wanted to find investors, to engage investors for their value they bring to the company and not for the capital itself. So which is quite interesting, because you think that money will resolve everything for you as an entrepreneur, but it won't. You need to see what else can my investors bring on board. True enough, you have a funding gap, but also you need to understand what else beyond the funding gap do I need to take, do I need addressed as well. So what is a typical process? I mean, do you apply for them 3 times before they give you a call? Or do you apply to them and then you wait for 3 years before they give you a call? Because they must have a process. What is the process? Just to describe ours briefly, is you make an application, and then within 48 hours, you get a response from one of our analysts telling you that this is what we need, or can we jump into a call for you to better understand your position on your business as well. And then after that, of course, it progresses to now a physical, but given the current situation, we are having them more virtually. And once you have a virtual engagement with your entrepreneur, once you understand them better, then you can start getting into more intricate details of now start planning a due diligence and present them to the investment network as well. So that is our process, and that largely takes around 1 month. But other people have different processes, and it will be good for you to understand what their processes are, because you don't want to overshoot your expectations or for some reason dismiss them because they don't seem to be responding to you as fast as you want them to respond to you. No, these are typical process, and you need to understand it so that you can at least pace yourself with regards to their process as well. And then, can they fundraise in future? What kind of investors are they? So can they fundraise in future? Can they help you look for additional capital when the need comes? That is something else that you need also to be quite aware of, or you need to be quite interested in if you're looking for value-based investors. So where can I look for investors? Of course, if I can just summarize in word form, the map that I had already indicated earlier, then you can say those are the different sources where those investors that I highlighted in that were highlighted in that map may be accessible from. So of course there's VC4A. I don't know how well conversant you are with the different organizations here, but it would be good for you just to have a look at them and see, especially when you start fundraising, how do I position myself to see what they can bring in from a fund, or more importantly, from helping me become visible to investors, because largely they are platforms that help you become visible to investors. Great. Again, please, before we move to the next session, if there's anything that has not been addressed in the previous session, kindly please send it forward, and then we'll be able to address it at the conclusion, as part of the conclusion of this session as well. So now I'd like to move to, and I've already seen some questions, so I'll be able to address them as well. Now let's move to a very important part of the whole investor readiness and engagement process, which is structuring the deal. Now you have agreed. Now you have sat down with the investor. They like you, they like your company, they like what the numbers are showing. They have done their due diligence. They think that there is commercial opportunity. They have done their due diligence on you. They think that you're an upright fellow. Everything checks out. You don't have a bad history. You don't pay in any CRB. You don't appear anywhere. So you're good. So now, can we have a deal? Now, at this point, now we sit down and say, what do I want? How do I structure the deal that is good for me? They want to be part of my company. How do I make sure that making them part of my company is not detrimental to me? This is where now the deal structure comes in. And this is what I had identified or defined as the term sheet. Because in that term sheet is what will be articulated, what you discuss with your entrepreneur, what you discuss with your investor, brother. So let's get into it. What are the key elements? Why do we need to understand the term sheet? Because it covers the immediate transaction. And secondly, it establishes the rule of engagement. And thirdly, it covers other things that investor might be interested in that are not necessarily either corporate governance based or financial based. And we look at them independently. So what are the key provisions? What does it provide for really? What does the term sheet provide for? It provides for three things. How do we split the rewards? How do we share control? And how do we align our interests? Because keep in mind, from here henceforth, it's the two of you, not just you. It's you and your investor. So you need to understand, how do I split whatever value is going to be generated in this business? How do we share it? And how are decisions going to be made in this business? How do we come to an understanding? Are you making the small managerial decisions and you leave it to the board to make the large decisions, or are you entirely the control maniac that says I'll make every decision, big and small? Or or is the investor the control maniac that says you cannot lift a finger without consulting me? Are they micromanaging? So how do we split or share control? And then for us to be able to do that, how do we align our interests? How do I make sure that what you want is also something similar to what I want? How do I make sure that if once we sign, I don't say, well and good, my job is done. I've gotten an investor, let me go sleep. How do I make sure that you keep on doing what you're doing as an entrepreneur so that you can have some value which will be worth splitting? Have a business that will be worth making decisions for. Those are the three provisions that the term sheet covers. Or besides the element of the immediate transaction and the rules of engagement and the other provisions that bring them other things that are not financial or corporate governance related. These are the three provisions, or this is the raison d'etre of term sheets. I hope my French is up to par. If someone is laughing, thankfully I can't see them. So anyway, so let's get into the different provisions. We'll look at the first one, splitting the rewards. What does this mean? What are the terms? What are the clauses? What is necessary? What is normally used to make sure that there's a fair reward system, or what is largely considered to be used as a way of making sure that you distribute the value from the company adequately, or at least in recognition of the person. That is why we look at. You need to ask yourself, what is the financial instrument that is being used? So that is largely covered by the type of investment they'll be making. So for an investor, the selected financial instrument is largely going to address how you want to reap the reward. And for the investor, the financial instrument is going to decide how you pay value to the people giving you money, simply put. So Of course, like I said, it's going to cover the repayment terms. Is it a loan? So if maybe someone wants to extract value or they want to share their reward from an interest point of view, you're going to give them they're going to give you a loan agreement, and then on that loan agreement, they'll stipulate the repayment terms. Is it time or is it immediate? And then on that basis, you can decide, do you want to pay value to your investor like that, or don't you want to pay value? So that splitting, that sharing of value is going to be determined by the repayment terms or the terms that are in consideration from the instrument. So interest and fee structure, how much does it cost to give value to your investor? How much does it cost me as an investor to extract value from you? So that is also something else, that the fee structures, what are the interests, rates you can feel as if you consider yourself adequately compensated for the risk or the value that you're bringing to the company. And then what other requirements do you have? I mean, do you need conditions? Do you need certain financial ratios met, or do you need other metrics that someone else must fulfill before you give them any funding? And as an entrepreneur, you also look at this and say, should I jump loops and hoops to make sure that I access your capital? No. If you get these other requirements, then you can also better place. You can be able to decide for yourself if this is a conversation that you like to take forward or not. And then probably the last one is things to do with drug clauses and options, and we'll talk a bit more about them. But you see, now these are additional investor requirements that, what else do they put in place so that you are aligned or you are fulfilling the bargain? And those are some of the things that they put in there, the drug clauses or the options that you put or embed in a term sheet to make sure, or in the financial instruments term sheet, to make sure that the entrepreneur, you can say, leads out to their part of, leads to their side of the bargain as well. So what are the common financial instruments that are used? So we have ordinary equity. These are just shares. Preferred equity, it's preferred shares. And then we have convertible debt. That is a debt that can convert either equity or into either preferred or ordinary equity. And then we have straight debt from a bank. I mean, simply put, straight debt is just your commercial loan that you get from a bank, or it could be your commercial loan that you get from an MFI, or it could be anything that does not necessarily look like the other elements above. It doesn't involve ownership at all. It's your debt. So that is what we call straight debt as well. I'm going to start with ordinary and preferred equity and just highlight a bit of how they look like and what it is about them, and that makes them preferable or not preferable. So having looking at that diagram there, you can of course establish why an investor will probably preferred equity as opposed to ordinary equity, because largely, besides from a returns point of view, preferred equity is better because it gives you a higher coupon, of course, than ordinary equity, which does not give you a coupon. And then, of course, it protects the investor's interest and ranks higher than ordinary equity. The reason people might want ordinary shares is for the voting power, because as an investor, if you don't have voting privileges, then probably you also risk the return that you can get from a preferred equity perspective. So both of them are different. It depends on the kind of investor you are, or it depends on the kind of investor that you are engaging. And depending on how they look at it, then they can say, if I want to have voting power, then probably I'll go for the ordinary. But if I want a higher return, probably I'll go for the preferred equity. And those are I would say those are the real differentiator between the ordinary and preferred equity aspects or financial instruments. And then let's look at the other one, the convertible instruments, the one that now converts into equity. I mean, simply put, they have features of equity and they have features of debt, because as the name suggests, convertible means to convert, of course, in future. So some investors prefer this because they don't want to take the risk early enough of owning a stake in the company. So they give you capital which has the potential to convert into equity. So largely that is what we refer to as a convertible instrument. There are different types, of course. So they have, like I mentioned, they have debt-like features and they have the ability to convert into equity later on. But why convertible? Because, of course, as highlighted, they rank higher than ordinary or preferred equity because they are a debt. And then secondly, they are easy to disburse because I can sign a convertible note with you today and you'll have money in your account tomorrow. As opposed to equity, I need you to start doing some registration documentation at Sharia House, give me this, start transferring shares, come get some share agreement written out, get all these other things put in place before you can actually access the funds. But with the convertible note, you access the funds immediately once you sign upon it. And also it defrays or rather kicks down the problem of establishing a valuation. Remember earlier on, I told you one of the challenges that as investors we face is agreeing on what your company is worth, agreeing on the size of the pie. That is quite a difficult conversation and you want to have it as early as possible, or if you can avoid it, avoid it. And convertible instruments are one of the means in which both entrepreneurs and investors are using to avoid that uncomfortable conversation. Because if we cannot agree now, why don't we let someone else agree for us later on? Or why don't we wait until we get some good amount of traction, which we can adequately use to objectively value the company? So you just keep on postponing the problem until later. And that is why probably they are the most common and probably preferred financial instrument for any investment. So types of convertible instruments, like I said, I'll highlight a few, but I'll also point out the one that is largely or usually used in this part of the region. So what are they? They are traditional. Of course, there's a traditional convertible debt, and then there's the safe agreement, and then there is the keep it simple security. I don't know how many have interacted with any of these documents, but sometime in future you will probably interact with one of them. On our side, we have already used both the traditional convertible note and we have used a simple agreement for future equity already. They are quite similar. It's just that one has an interest, the other one does not have an interest component. And the same for the keep it simple security. It's more similar to the safe than to the traditional debt instrument. And if just to highlight very fast, those are the different elements and why they are preferred or why they are chosen above, besides from each other, or rather besides the ordinary equity option by an investor. So sharing control. Now we move to the second element or the second provision of a term sheet, or why we need to structure a deal properly, which is to share control. And this is very important because if you cannot run a business together with your investor, then it will be very difficult for you to create any value. As simple as that. So sharing control and sharing management or decision making, etc., 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 is quite important. It's quite necessary for an entrepreneur and for an investor while coming up with an investment conversation or investment deal. So maybe just to highlight how our decisions are made in a company. Of course, the highest is made, the biggest or the most important decisions are made by the shareholders. These are the providers of capital. And then they delegate that responsibility periodically to the board of directors, of course. And then the board of directors further delegates responsibility to the management team. So this is generally how decisions are made, which we are quite familiar with. The reason I'm highlighting it is because an investor will want to be part of one of these three structures. And then they either want to take a shareholder position, which is with their equity, then they can move, or they want to take a board position. Either if you're doing a debt or a self agreement, you can get a board position. But largely, of course, they won't get a management, but they will influence management. So once you understand this is how things are, then you'll be able to see which aspect does my investor want and where should I limit them? Where should I limit their exercise of control, and how much control should I give them with regards to the three different elements of decision-making bodies in an organization. So what are the clauses used to just make sure that the control is being shared adequately or in relation to how the value is being given to the company by the investor? I mentioned there's board appointments and decision making. There are some decisions that you can make. And then also they use a lot of protective clauses just to make sure that the investment is well protected. Then they also use some exit clauses that make it easy for them to extract value at the point of exit as investors. Sometimes they use exclusivity clause, whereby they say you cannot get a similar investor like ours, or you cannot get a similar, you cannot start doing things that quote unquote put us in bad position as an investor. And then something else that also uses are things to do with information rights. They might require you to pass information on a monthly basis or on a periodic basis, but whatever the case is, you have to be comfortable with that information rights they want. If you're not comfortable, that is why I always say you don't have to as an investor. And probably they will also have rights, or by they say, and this largely have to do with when it comes to additional funding, who gets the quote unquote rights, some privileges when other investors are coming in, that they can be able to safeguard their interest even though you are seeking additional or external funding elsewhere. And then there are things to do with transfer provisions. I mean, can you transfer your shares to your next of kin while they are still investors in your business? They can also come up with limitations as to what you can do with that as well. So these are the clauses that really are used to distribute control and distribute decision-making process and distribute any other element of corporate governance that you might, investor and entrepreneur, may think of. But I want to focus on the protective clauses, because now that is where really as investors push for their right. And on these protective clauses, and the other one, which is the exclusivity clause, because also that somehow limits to how much engagement you can have with external parties as far as fundraising is concerned. So I'm going to look at those two largely, because the others are pretty much straightforward, as I've already mentioned. So protective clauses. So you might think these are bad for you, but they're not really bad for you, because at the end of the day, this is your lifelong occupation. Your company is your lifelong occupation. But for me, as an investor, it's not my lifelong occupation. I'm not going to be here ad infinitum until kingdom come. No, I'm not going to be here until they change the constitution again. I'll be here for a very short, limited time, and I need to make sure the time I'm here that I extract as much value as much as possible from you. Whatever you do with the time after, that's up to you, really. So it's not really a bad thing. I'm trying just to highlight that fact. So what are the examples that you can be covering in the protective clause? They can say you can't change the nature of business. Let's say you are an airplane that is doing, rather not an airplane, but let's say rather you are a company that is selling flowers, or maybe providing logistics. The business in which they invested in is the one that is the going concern. So you can't change your business abruptly or declare the expenditure. One of the companies that we have invested in, for instance, they cannot raise loans of a certain percentage with regards to our investment. You cannot raise a loan of a certain amount above or of a certain percentage from what we have invested in. So let's say we put in $1,000. You can say, no, sorry, not 1,000. That's too little. Let's say we put in $100,000, which is an equivalent of 10 million. We say you cannot raise 10% of that money. without consulting us, because then it's almost matching. If you raise anything beyond that, it's almost matching our investment. And then removal of independent directors. You cannot remove someone or make appointments of people that are not aligned to what we have, and make expenses to a certain limit. You cannot, for instance, worth 500,000 without bringing it to the attention of the investor. So things like that. So they really use some elements or some clauses to cover some of those issues to make sure that at least some of these issues that are highlighted here are protected by the investor. And the other one is exclusivity. So this is the time you don't have to talk around this. It's largely referred to as a no-shop clause, because now you cannot, if I start talking to you, it's like being engaged to someone and then they are dating someone else. That can happen. So that is, we tie you down to an exclusivity period. If the deal is coming, it has to be, first of all, it has to be structured the way you want. And second of all, you don't offer it to someone since you've already identified it as a potential deal for us. So it's not really too long. It's probably, the exclusivity clause covers the diligence stage and a bit after the diligence stage. And after that, then you are free to go. If the deal does not materialize, then you're free to go if you want. So now, lastly, I would like to talk about, at least for this section, I would like to talk about aligning interests. How do you align your interests with your entrepreneur, or the investor align their interest with the investee? And maybe the most important question is to ask why. I think I'd already alluded to this, because you want something from the company and the investor wants something from the company as well. To reward founders and key executives for value creation. And then something else is to tie people, because like I alluded earlier, you don't want to invest and then someone takes off and then they start doing other things. No, you want to tie them down to what it promised. While they were raising funds, they go ahead and do it. They don't leave it to someone else. They are the ones that are going to implement it. And that they are properly motivated and they are full of energy to make sure that they execute as expected. So those are the main reason we normally try to align our own interests as investors to our investing company. How do we do this? So the first one is we create stock options. Well, there are various ways in which we do. As we prefer the vesting of shares, but other investors prefer creating and allocating stock options. But as Victoria Ventures, we prefer the vesting of shares to founders and executives. What does that really mean? It just means that you cannot, for instance, let's say you own 80% of the business. You cannot liquidate any of those shares within the first. So you have to wait until perhaps, and you can sell a portion of your equity. So that is what really vesting means. It largely refers to the fact that you cannot really sell your shareholding until a certain point in, and time period has elapsed as well. So, and also intellectual property assignment. Some people can come out and, assign the intellectual property from the individual to the company, so that at least you don't run away with it. And then lastly, maybe the representations and warranties, which is mainly to say you as a company, you represent that some things, the information that you shared with us, and you warrant it and you say it was true and fair. And if it's not, there are punitive clauses to make sure that we recoup our investment. So those are the main ways in which we do, in which it's normally done. But the way we do it as Victoria, like I said initially, is largely we use vesting and also some bit of reps and warranties. So what are the key issues when it comes to aligning? Because everything is not smooth, of course. Stock options, of course, it's stock options is one of the issues that come up, and we say it's going to be quite an interesting one, because how do you provide stock options, and what pool of, or how many, or what percentage of stocks are you going to allocate to make sure that these are the ones that are going to be offered to the executive and founders as a reward mechanism, to make sure that they are aligned with you as an investor, because they think that their value should be this much, and you think their value should be this much. How do you come to an agreement? And at what point in place can they exercise that stock option? And again, I say vesting, and what percentage of shares can you sell after a certain period of time, and in what form, and after how long can you sell it? So those two are the main issues that will come on during aligning your interest if you use some of those elements that are highlighted earlier. So, some general rules when structuring a deal with an investor. As an entrepreneur, try to keep it simple and think win-win. That, of course, we have this mentality where I don't have to win, but you have to lose. No, we have to think win-win. All the time, think win-win. Then another one is to ensure that you understand what you're signing. Understand what you're signing. You don't sign something, let's say you have signed a representation under warranty about some initial information that you provided and it turns out not to be true. And then the punitive measure is they liquidate you or they move you away from your CEO founder role. Are you in agreement with that? So read the agreement and make sure that you understand it before you sign it. And remember, last but not least, and I'm sure gentlemen in the audience will agree to this, it's a marriage, not a wedding. So the wedding, don't focus on the wedding, focus on the marriage, the part that comes after you get the money into your company. That's the most important part. So some resources, you can have a look at that. They'll have more information on the different instruments that I just highlighted initially. Again, you can send questions regarding that session, and then I would like to jump into the last section of this session, and then you can see how we can tackle it. Of course, time has gone a bit ahead than planned, but we see how we can adequately cover it and see if there are any questions, at least regarding the initial session. You can address them, and then you can share them, and then I'll address them at the end of the sessions. So let's get into negotiation. So what is negotiation? What is a negotiation? I'm sure you are familiar with what is a negotiation. It's quite evident that we do it all the time. Negotiation is trying to agree, trying to get into some form of agreement that benefits you and benefits the other person as well. So this you have done probably with your client when you're signing a new business. This you have done also maybe when you're looking for money with a VC, or with your business partner or employees. They come to you, they tell you, I want a salary revaluation. So you start negotiating what is a fair revaluation. Or with your other partner, with your social partner, you can negotiate that this is why I don't think we should buy this car, this is why we should buy this other car, or this is why this maize flour is better than this. You negotiate all the time. It's a conversation, and we always engage in people, trying to get them to, you can say, see our interest and get them to buy into our view. So we negotiate all the time. So what are some of the rules that you should keep in mind? You never get anything that you don't ask for. You will never get it. There are no good Samaritans when it comes to investments. There's no one who's a good Samaritan dishing out money. No, you'll always have to ask for it. Even the grant funders or impact funders, they're not good Samaritans. You have to ask them. And you have to prepare a proposal for them and then make sure that they see what you're trying to say, and then you negotiate something. At least you will not get anything from them if you don't ask them. And then have the ability to say no. Say no when it's a bad deal. Say if you don't like something in those terms that are initially in the previous slides, say no and walk away and say, okay, fine, you know what, it's okay. We don't have to get into this. There are more than one funders for you. There'll always be more than one person that is willing to look at your idea. So just walk away if the deal does not make sense for you. And then don't negotiate unless you have something to offer. Create value first, and then you negotiate. It's very hard for you to negotiate by that I mean if you don't have anything to show. It's very hard for you to win someone else over or convince them that you should really look at your opportunity from a funding point of view. So just make sure that you have value that you have created some bit of value, and also that you have a lot of You have something to show for it. And then don't discuss price or cost until you're ready to negotiate and close the deal. Don't send the pitch deck and say, I'll give you at this valuation, or I'll give you my company at this price, or I'll sell stake for you at this price. No, wait, let them have a look at the company, let them see let them have a bit of rough understanding of what the company is like, and then let them come as well to you with an offer. And then you can start saying, okay, fine, let's now start talking about the price and what it will cost you and what is the price for this. And then know when to say it. Just know when to keep quiet. More importantly, when to listen, because more often than not, you'll pick up a lot of things from what the investor is saying by just listening to them. Just listen to what they have to say. And then once they speak, then you can say, okay, fine, because you learn a lot, someone who says a lot. And then never tell the other party what is make or break for you. What is your bottom line? What can't you do? Don't tell them that. Let them find out over time, or let them never find out at all. And then on that basis, you can say, yes, I'm willing to go with this, or I'm not willing to go with this. So those are some of the few rules that I would like to mention, but also maybe just to highlight a bit of the critical elements of negotiation. Knowledge is important. Knowledge or information is key. Knowledge is power, they normally say. But I mean, if the more knowledgeable you are, the better it is you are placed to negotiate from a position of advantage. And time or deadline pressure do not necessarily succumb to them. You don't need to negotiate when you're pressured. If you're backed up against the corner, you'll make the worst decision. So make sure you have time. Even that is why the whole element of planning for investor readiness is important, because negotiating is going to be part of the process. And it's going to be also probably a long process. You need time to make sure that you don't feel pressure to accept the money. And then strength or power of the party. You always have an advantage. If you're coming, you always have an advantage if you're the one who makes or proposes the deal. Propose the deal to them. Ask them, okay, fine, this is what I'm offering. I'm offering investors in my company this deal. So let's start negotiating that. Because then, if you cannot raise your expectations if they've already been lowered by the investor. But if you offer a position of high expectation, if they reduce it, you'll get to a point whereby you are okay with it, as opposed to them coming with a very bad deal and trying to upscale it. It's very difficult. So try to come up with a deal and say, this is what I'm offering, and then let's talk. Or because if they come to you with a deal, the only way is it's harder to go up than to come down from your deal. So the currency of information, the currency of any negotiation is information, and time. You need to have as much information as much as possible, and the time adequate for you to plan for it. So when do you walk away? When do you say no? When do you walk away and say enough is enough? Walk away when the other party, when you feel threatened. If the person is trying to, it's not just spoon feed, but also just to push food down your throat, then, or you're very uncomfortable with the kind of opportunities that they're asking, or if they come and tell you want $10,000 for 50% of your company, then you tell them, no, come on, that doesn't work. Or if they tell you, we'll invest in you, but now the CEO has to be my nephew. No, come on. When you feel threatened or don't feel comfortable, just walk away. And then they use unfair tactics. So for instance, they start telling you, I'll fund your competitor, or I'll go withdraw your license, or I'll pay someone to get rid of your license. Then if they start using unfair tactics of getting you to the negotiating table, then tell them, no, this we can't do, because already in itself, the relationship is already pressured. So you really don't want that kind of person to make a deal with that kind of a person. So what is negotiable? Valuation is negotiable. You can negotiate on the board composition. You can negotiate on vesting. and then you can negotiate on everything is negotiable. So just to highlight a few things that are also negotiable, but just know that everything is negotiable. What is not negotiable, articulate it initially. Make sure that people know that this is not negotiable. That, for instance, you cannot lay off 10% of your workforce if they make an investment. If you tell them that that is not negotiable, that is not negotiable. Or whatever else is not negotiable is not negotiable. So, but everything else is negotiable. I just want to highlight a few things, but like I said, valuation is just one of the terms. Don't get fooled by it. Look for a good package, not just a good valuation. So that is something that you should put in mind there, but everything else is negotiable. So what really makes it difficult to negotiate is not differentiating between positions and interest. So what is a position? We can say a position is what the stance that you take, but an interest is why you're taking that stance. So learn to understand the interest and not focus on the position. Positions might change, but interests are sort of eternal and they are very enduring. So you can change a position because you can change your position, but your interest has not yet changed. So learn as you listen. That is why I said it's very important to listen. Keep quiet and listen, because as you listen to an investor talking, then you start seeing what actually their main interest is. And then once you address those interests, it's easy to come up to a good deal between yourself and the investor. So just communicate that thing. So what is, last but not least, what will I advise entrepreneurs when it comes to the investment process and investor readiness and fundraising? It's a full-time job, like it or not, there are cycles. So you'll fundraise now today, 2 years later you'll fundraise, you'll keep on fundraising until when you adequately cannot get, when external capital is not what you really need. And ensure that you have all the documentation, prepare for it well. And last, something else that also you should keep in mind is learning to respond as soon as possible. There's nothing as bad as sending an email to an entrepreneur and asking them if they can update their stack or their pitch deck with some information that you might require just to start evaluating them again. And then they take 2 months. You wonder what they've been doing or if they're actually serious about raising the money. So try to respond as soon as possible. And if you can't, give a reason why you cannot respond as soon as possible. It's good to get an NDA or not. It depends really on the level of information or depth of disclosure that you have to make. But it's also, you can ask for an NDA if need be. Something else is use an advisor, or if you cannot get one, try to see if you can get even another entrepreneur that has raised money to come and help you, at least engage another investor. And an advisory board is also good to have. It's like the advisor above that I mentioned, but an advisory board, you don't have to have them, but they can help you a lot when it comes to engaging investors as well. And then remember, don't settle for a bad investment because you need the money. Again, I stress, the money is not everything. It's not really everything. There's a lot that the money does not disclose, but just get a good investment. Don't just look for the money on its own. So with that, I would like to call the session to at least that part of the session to a close. And then now we can move to the question and answer. And I would like to respond to some of the questions that have already been asked. And I'll respond to them sequentially. So the first one was, what are the main expectations of investors from entrepreneurs? Expectations of investors from entrepreneurs. And I think I can go back to the slides and say we have somehow alluded to it. It's the most important one, I think, is learn an entrepreneur who, first of all, understands their business. They have a product market fit. They have gone out to the market. They know what it is they know what it is to say when they are selling something or when they're presenting something to an investor, that they are well conversant with what it is that they're presenting and they understand the customer base. So that understanding of what it is that you're trying to fulfill in the marketplace is very important. We need to see you understand that. Another expectations, of course, is to be very responsive in one of the last parts that I just alluded. Be very responsive as an entrepreneur. If we say that we need information as soon as possible to help us progress with decision making, please try to provide it as soon as possible so that at least it can free us to do other things or to make a decision as far as you are concerned as an entrepreneur from an investment point of view. Something else that I need to understand is also to see investors. You're an entrepreneur. Also, we expect you to see investors as people who are undertaking a risk with you, not just people who are coming to, can say, colonize your company. No, we're coming to see how we can work to extract value from what you're doing. So learn to see them as people who have something to lose. And more importantly, people who also have the same risk exposure or are trying to cover their tracks or to cover their downside as much as possible. And once you understand them from how they review or look at risk, then it will be easy for you to see how you can at least address some of their concerns as you present to them. So that one, and then I'll move to the next one. What is the average VCs are providing in the scale-up phase in East Africa? It really varies. I mean, I will say you need to look at it from a different perspective. Early stage space is considered between $50,000 to $1 million. So they're looking at that space as early stage largely. Of course, there is categories of early stage. There is prototype, there's a bit of growth in the company, a bit of traction, etc., and the one that has some significant amount of revenue, and then they're looking for money for proper growth. So there is VCs. So once you define that space as that, then you can see VCs are giving anything between $50,000 to $900,000 to $1 million. And then beyond that, where you're looking at now at the company is looking to scale up, it depends on the level of scale up that you want. So there are mid-sized funders, which are looking at anything between 1 to 10 million, and then there are large-scale funders who are giving anything between, above 10 million, probably close to 50 million. Of course, there'll be bigger people that are giving above that, but that is not at scale up. That is more of a mature enterprise. But for a scale-up perspective, we're seeing anything, if you consider yourself as a scale-up in the early stage, then it's anything between 50 to 1 million. If you consider yourself as a scale-up in the growth stage, then it's really between 1 to 10 million. So what about project valuation? Is the third and last question is to do with project valuation as a limitation to access funding from investors. Going back to what we said already during the session is, the first thing I'll always say is, if you can avoid it, avoid the conversation of valuation. Just avoid it. Or use the other instruments that don't necessarily make valuation a core element in the conversation. And that is convertible note. Of course, you can look at the SAFE agreement. You can look at or the keep it simple agreement. So you can use either of the varying instruments that can somehow help you avoid the conversation of valuation immediately. But if you cannot avoid it, it's largely investors base their valuation on what they can see. If they cannot see numbers coming from your company, let's say you're prototyping, and they can't see any number coming from you, so it's very hard for them to give any sensible or good valuation on your business. So try to see what can you produce to them so that they can be able to adequately use that information to value your business in the same way that you see yourself valuing it. But again, if you can avoid it, just avoid it. But it is a limiting factor, because entrepreneurs more often than not, they try to use information coming from different ecosystems to value their own companies in this particular ecosystem. So sense check your valuation, be logical about it, and rationalize it in the way an investor will rationalize it. And don't be too, not over optimistic, but naive as regards to what you think your company is actually valued. And with that, ladies and gentlemen, I would like to say thank you and for participating, for being part of this session. And I'm sure the sessions for tomorrow, as outlined by Dr. Mwanza, are going to be very engaging and fruitful for you. And we hope that you'll be able to be with us during the course of this conference. Asanteni sana, take care of yourself and have a lovely evening. Thank you.
Good to see you again, and I hope that this has been a very useful and powerful session. Jason is still available, and we've got his contact, and if you want to engage with him beyond here, that opportunity is very much available. Right now, just in closing, I will invite you to participate in a post-event survey, and you are also invited to submit some comments about this particular session. That way we learn on how we can do it better going forward. So that survey will be available electronically. I want to thank you as attendees for participating and giving meaningful feedback. Thanks to Jason for the good facilitation. Thanks to our partners, Mlika IT, University of Nairobi, Kenya National Innovation Agency, ASEC, and so on, Bafunde, who have hosted us here. And I hope that this conversation also continues online through our hashtag Mlika Startups and Mlika and Kenya's Emerging Startups 2020. And that we continue to tag at Mlika IT Africa, at ASEC News, at Kenya Updates, at Bafunde, as well as at UONBI. There is an opportunity to network online. So if you look at the left side of your screen, there is a button that you can click for networking, and you can have conversations with very specific people. Tomorrow we resume here at 9, and we will be starting our session with a welcome, and then we begin to engage 2 startups that have succeeded in resource mobilization, and then after that we'll pick another 2 set of startups. Thanks very much, and I hope to see you there. Pass word around if you can. Otherwise, thanks very much. My name is Dr. Tonio Mwansa, current CEO of Kenya National Innovation Agency, and I look forward to hosting you tomorrow at 9. Thank you and bye.